Welcome back to the Deep Dive. If you're tuned in today, you are likely feeling what everyone else is feeling, just navigating that choppy, frankly nauseating market we've seen over the last few weeks.
Oh, absolutely.
There's just this period of intense investor anxiety, especially if your portfolio is heavy in, the tech and growth stocks that were leading everything.
I'd say it's more than just anxiety at this point. For many, it's genuine pain. And the fundamental question that everyone is wrestling with is, well, it's simple.
When does it stop?
When definitively will this market sell-off end? And we have an incredible set of sources today that I think let us bypass all the emotional headlines and just focus on the cold, hard logic of the market, institutional money flows.
So that's our mission for this deep dive. We're using this analysis, which was written, by the way, right in the thick of it on November 20th, 2025, to give you a real shortcut.
A shortcut into the mechanics of it all.
Exactly. We're drilling down into that supply and demand picture that's really created by the biggest players on Wall Street. We want to know where the big money is and, maybe more importantly, where it isn't.
Because that is the ultimate predictor of a market bottom. We're not looking at sentiment surveys or, macro forecasts.
No.
We are tracking the money that actually has the power to move things. The power law of movement. If we can see when the big players are finally done selling, we can see the bottom forming.
Okay, so let's unpack this.
Yeah.
And maybe start with a reality check. For a lot of this year, the major indices felt kind of protected.
Right.
You had the Magnificent Seven stocks acting like these pillars, holding everything up so the S&P or NASDAQ numbers didn't look too scary. But the source material we have confirms that narrative is, well, it's dead. What's the true breadth of the pain we're seeing now?
The breadth is everything. That is the key takeaway of this recent decline. For months, you might have seen 40% of stocks going down, but the indices held up.
Because of those 7 stocks.
Yeah. Because those 7 mega caps just kept marching higher. But now this analysis shows that nearly all stocks are in a downtrend.
It's a structural shift.
It is a huge structural shift. It's gone from a narrow correction to what the source actually calls carnage.
Let's put some data behind carnage, because it's not just a slow drift down. We're talking about huge double-digit losses in the names you really rely on.
That's right. I mean, look at the specific damage in the stocks that defined the entire last bull run. Most mega-cap tech stocks are now firmly in correction territory.
Which means they're off double digits from their peaks.
Double digits, yeah. We are talking about the heavy hitters, Meta platforms, Netflix, Tesla, Amazon, Microsoft, and NVIDIA.
All of them?
All of them, all showing weakness at the same time.
And the duration here is important, too. This isn't just a 2-day dip.
Not at all. Many sectors outside of tech have actually been correcting for months. But it's now that the institutional selling has finally hit those largest names.
It feels inescapable.
It does. And that's why this matters to you directly. If you're looking at your portfolio and it's down, you're experiencing a synchronized, broad-based pullback.
It's not that you picked the wrong stocks.
Exactly. You are not dealing with a failure of stock selection. You are dealing with a structural reduction in institutional risk exposure, period.
And that sets up the next crucial question perfectly. If we agree the institutions are driving the selling, how do we track them in real time? How do we cut through all the retail trading noise and just focus on that big money footprint?
Well, we rely on a statistical tool, and it's called the Big Money Index, or DMI for short.
Okay.
Think of the BMI as your North Star for seeing these institutional money flow trends. To build it, you track every large institutional trade, the ones that actually move the needle, and then you measure the ratio of buys versus sells.
Why is that statistically better than just looking at, say, average market volume?
It's because of the power law of capital. Retail investors might trade emotionally, chasing trends up and down, but institutional money, we're talking pension funds, hedge funds, sovereign wealth funds, it moves with discipline. When the BMI falls, it means their inflows are slowing, and critically, their outflows are growing.
So when those giants stop buying or start selling,
the market has no choice but to drop. It's the fundamental supply and demand equation at work.
All right, so let's get to the current reality. Where is the BMI sitting right now as of this analysis on November 20th?
It currently sits at 46%.
46%.
And what that number means is that of all institutional activity, buying flows are only slightly outweighing selling flows. But more importantly, this 46% reading is the lowest we have seen since late April.
So it confirms the pain everyone is feeling. It's statistically validated by this retreat of big capital.
It is, and the raw numbers behind it are really concrete. The analysis shows that just in November, institutional outflows have outnumbered inflows by a ratio of 2 to 1.
2 to 1.
Now, yeah, it's 1,546 red selling signals versus only 877 green buying signals. That divergence, it paints a very clear picture of an institutional retreat.
So that's the immediate takeaway.
That's the immediate conclusion. This sustained, measurable slowing of institutional buying is directly driving stocks lower. We aren't guessing at the cause. We are looking right at the engine of the selling.
Okay, now we get to the part that feels a little counterintuitive. The fact that the BMI is so low is actually the best news we've heard so far.
Huh, yeah. It seems strange, right?
It does. We're apparently approaching a level that statistically suggests the worst of this decline might already be behind us.
That's the key insight from this research. A low BMI isn't a sign of, impending doom. It's actually approaching a historical zone that forecasts dramatically better than average market returns.
Okay, before we get to that aha moment, let's just set the stage. What's a baseline market return we should expect in a normal year?
Well, if you look at the S&P 500 over the last decade, the average return is about 12% a year. That's your benchmark.
12%. Okay, here is the critical data point you need to remember from this entire deep dive. What is that magical threshold we are looking for, and what happens when we cross it?
We are hunting for the 40% threshold. When the BMI falls below that 40% line, the average forward returns across the 3-month, 6-month, and 12-month timeframes nearly double the market average.
Hold on. So we're at 46% right now. A 6-point drop from here changes the statistical outcome that dramatically.
It does.
Why? Why does going from 46% down to 40% unlock such explosive forward returns?
It's like the institutional version of a stretched rubber band. When institutional buyers become that scarce, when the index drops below 40%, it means the market has purged most of the willing sellers.
Okay, so the only people left selling are weak or forced.
Exactly. The market becomes technically oversold. Statistically, the downside from that point is limited, and the valuation opportunity for patient capital becomes enormous. You are right back to validating the oldest saying on Wall Street, buy low.
And the institutional flow signal tells you exactly when the market is statistically low.
That's it.
That makes perfect sense. So we're hunting for that moment of maximum institutional pessimism because history shows it almost immediately precedes a tremendous opportunity. But the BMI, it gives us a correlation zone, right? 46% heading toward 40%.
Yeah.
It doesn't give us perfect timing.
No, it doesn't.
So if we want to nail the definitive acute low, we probably need a different kind of tool.
Absolutely. The BMI gives you the long-term context. It answers the question, are we oversold? But to capture the short-term reversal, we need to spot true, desperate capitulation.
That moment where the last sellers are just forced out no matter the price.
Right.
And that brings us to this unique metric in the analysis, the forced capitulation trigger. Tell us about the FCT.
The forced capitulation trigger, or FCT, is an indicator designed specifically to spot that moment of forced selling in real time. It's a very high bar metric. Institutional analysts use it because it strips away all the retail noise.
And focuses only on the big players.
Purely on the systemic stress of the big players.
So how is it defined? What does that signal actually look like when it flashes red?
It is defined as roughly 400 equity outflows in a single trading session.
400. Let's put that in context.
Yeah, to put 400 in context, that amounts to nearly 30% of their entire institutionally tracked universe of stocks.
30%.
30% of stocks showing a major sell signal at the same time. This is not casual profit taking.
No.
This is often the result of systematic de-risking, maybe margin calls or automated strategies, all hitting stop-loss limits at once.
That's a powerful distinction. So when 30% of institutional stocks are being dumped in one day, it's a signal that the market has officially run out of willing discretionary sellers.
Exactly. The only sellers left are the ones being forced out.
And these red bars, as the source calls them.
They're rare signals.
Yeah.
But historically, they cluster precisely around major market reversals. It is the definitive sign that supply is exhausted and demand is about to flood back in.
And the historical performance metrics that follow one of these FCT events are, well, they're just astonishing. Let's slow down here and really appreciate the size of the rally that follows this kind of institutional capitulation.
When you get 400 or more outflows in a day, the market doesn't just recover, it sprints.
So 3 months later, large cap stocks, the same ones that were just sold off, They gain double digits. That's a rapid turnaround.
It is, and then 6 months later, the results are incredible. The S&P 500 jumps 15%.
15%.
And the tech-heavy NASDAQ climbs 21.4%. I mean, that's more than a year's worth of typical returns in just half a year.
And if we look a full year out, that's where the data really screams opportunity.
12 months after an FCT event, the S&P 500 soars 23.5%.
Wow.
And the NASDAQ vaults an incredible 32.7%.
So this data makes a very, very strong case that capitulation isn't something to fear.
Not at all. It's the most powerful buy signal the market generates.
It sounds like this whole methodology is basically arguing that the risk of missing the reversal is now significantly higher than the risk of entering a bit too early.
That is the synthesis, yes. We've covered the pain, the statistical context, and now the timing mechanism.
So let's bring it all together. What's the final argument the source material is making to convince us that a bottom is near?
It's based on two converging points that are really telling the same story. First, a substantial amount of damage has already happened. The 46% VMI reading shows we are rapidly approaching that statistically significant 40% threshold.
The one that historically doubles forward returns.
Right, so the foundation for a major rally is actively being laid right now.
And the second point, that gets to the timing.
Yes. Second, if we haven't already hit the lows, the market is structurally positioned for that forced capitulation trigger.
The FCT signal.
And when that hits, history proves it is a near-perfect entry point for maximizing your forward gains.
So, given all this, what is the strategic advice for you, the investor, right now? Should you be trimming exposure or starting to add?
The strategic advice is, it's emphatic. Stop sitting on the sidelines and start hunting for all-star stocks now.
So be proactive.
Very proactive. Investors should be actively looking to add risk into high-quality names, the ones institutions love that just got sold off. Because these periods of extreme flows, they rarely last long.
The window to buy low is often pretty brief.
Very brief. You need a shopping list ready to go for when that FCT flashes.
And what adds some credibility here is that this isn't just a theoretical model. The source material validates its confidence by pointing to past calls it made.
That's right. They cite using this exact signal during other moments of maximum fear.
Like when?
They mentioned making successful calls at the April bottom earlier this year, and even more dramatically, during the COVID-19 bottom in March of 2020.
That's a great example.
It is. At that time, while most pundits were forecasting, a complete economic collapse, the flow signal hit that extreme low and predicted the massive rally that followed. It shows confidence in the process over the noise.
That history really grounds the argument for trusting these institutional flows over general sentiment. So we've established the damage is done. We know the big money index is at 46%, and it's heading toward that statistically powerful trigger at 40%. And we also know what a true capitulation signal looks like, that 400 outflow FCT event.
Absolutely. And I think the final thought for you to consider here is the massive difference between, guessing when a sell-off will end based on headlines.
Which never works.
Versus having a disciplined plan and a process based on tracking these institutional flows. When these flow signals hit extremes, the historical performance that follows isn't just good, it's explosive. A plan based on data helps you buy when the pain is highest, and history consistently rewards that discipline.
Something to mull over as you finalize your watch list. We appreciate you joining us for this deep dive into the true drivers of market reversals.